Well, hello again, everybody. This is John Norris at Trading Perspectives. We always have our good friend Sam Clement. Unfortunately, today, our other good friend, Courtney Truss, decided to save up all of her vacation time to the end of the year, and she is taking the week off. So we're just going to have to do without her today on Trading Perspectives. Sam, your thoughts on that?
Doing our best.
We're going to do our best, and it's going to be difficult because what we want to talk about today is what we anticipate in the upcoming year in terms of gee whiz, the markets, the economy, just geopolitical events, all that good stuff. There's too much to really talk about maybe in the 15, 20 minutes that we typically have here at Trading Perspectives. But Sam, I'm going to let you have the first stab at it. Just tell me, what is the first thing that you think will happen in 2023?
Well, I'm just hoping it'll be better than this.
And with that, thank you all so much for listening. I think that's a pretty safe prediction. If it's as bad as it was this year, I think you might have hair the same color as mine by the end of
I
next year.
think what's important about saying whether it's better or worse than next year is talking about what you're even talking about. Because, what we do for a living is, mostly involving the stock market.
Bonds too.
When people are asking, but the markets in general.
The markets.
What
when people think of the markets, they think of the stock market.
Right. And that over a short term can be very different from the economy.
Yes.
So I think that is, last week we talked about kind of recapping 2022 and, the economy maybe not as great as some of the GDP prints looked and not as bad as some of the other ones looked, and just kind of this bland market or bland economy rather.
It's the equivalent of a plain cheese sandwich.
Yeah, and so I think that is when we're saying I hope next year is going to be better, at least in the stock market, is I think, how bad the stock market's been and how different those can be. And so I'm definitely hoping at least the markets, the bond market, the stock market, all that will be better.
Well, I think that's a pretty safe prediction, Sam.
Yeah.
So, when you take a look at everything that's likely to happen next year, absent some sort of black swan events, but black swans seem to be increasing in frequency and what have you. They seem to be traveling in packs over the last several years.
There is millions of one in a million things that can happen, which means they should happen relatively frequently.
Pretty frequently. These black swans have been delivering black eyes over the last couple of years.
That's right.
But absent some sort of exogenous or extraneous event, really, it shouldn't be as bad as last year. The Federal Reserve will not keep raising the overnight lending target as rapidly as it has this year. Inflation will not be as great as it has been at times this year. In fact, I would imagine inflation to actually start decelerating pretty significantly in the first half of the year.
Yeah.
And the Federal Reserve might even start cutting rates sooner than what they anticipate. And why not? They've gotten everything wrong up till now. They might as well get their forecasts about when they're going to start cutting rates wrong as well.
Yeah, the most accurate thing they are is being accurate about being incorrect.
That's a little inside monetary policy joke for all those people out there listening. But in all seriousness, though, it's there's not going to be that same sort of pressure on the markets due to the Federal Reserve. Now, with that being said, that overnight rate is going to remain a little bit higher than folks would like for a while, but inflation is going to be coming down regardless. Just the way the numbers work. We've already seen goods inflation starting to come down. Heck, even crude oil prices are
down for the year.
Down for the year. All of this stuff, we're still seeing a little bit of pressure in services and what have you. But we're going to start seeing maybe that rental equivalency of primary residence probably start to slow down, maybe even start to fall, probably by March or April of next year, which will take the 12-month CPI down to very manageable levels.
Yeah, and that's something you and I have talked about a lot, especially going to lunch with clients and prospects and other people and saying when we're looking at this inflation data, when it turned up pretty rapidly, and the things that we're looking at that are, real time and not necessarily lagging in the CPI and PCE prints and all that, coming down, some of them are negative. And so I think that's something that I'm looking for, and I think you're looking for in next year, is inflation to come down significantly, and maybe, if anything, start to have a problem with deflation versus a problem with runaway inflation.
Well, maybe before we scare people with deflation, maybe disinflation.
Sure, at least disinflation. That seems like a slam dunk to me, is disinflation.
That definitely sounds like a slam dunk to me. If the Federal Reserve has to start getting aggressive and cutting the overnight lending target by next year, the back half of next year could be very explosive for the markets. However, beginning of the year, there's nothing out there in my crystal ball, and you know darn well I've got a crystal ball in my office.
Yeah.
there's nothing out there to suggest that the economy is going to suddenly surge to life, and there's nothing out there to suggest other than just hope by investors. Just investor psyche just improves just because.
Yeah.
There's nothing out there to suggest that corporate earnings are going to spike and that valuations are going to, there's going to be a multiple expansion in terms of valuations. There's nothing out there to suggest a massive rally in the markets either. We could get a January pop. I mean, sometimes that happens, but, it's not going to be, we're not going to see PE suddenly go through the roof from 17 or 18 where they are now out to 26 with the Federal Reserve still raising the overnight rate.
Yeah.
And we're starting to see corporate earnings be kind of meh, you know, so there's nothing there. I don't know what the impetus is going to be for that.
Especially for those massive expansions and multiples, that kind of thing, definitely not. But I do think, over a short term, and by short term in the markets, I'd say that's anything 12 months and under, the market, the stock prices versus anything to do with earnings rates or even economic growth over really short periods of time can very much separate themselves from one another. So that's part of what makes investing so tough is you can feel good about where the economy's going next year, and the markets can go one way or the other, completely separate.
Well, I would say this year was a perfect example of it. In 2022, as we mentioned last week, we did post a couple of negative quarters of GDP. However, the underlying data really wasn't as bad.
Yeah.
All told, probably the economy grew at a very sluggish rate this year, but the way the market behaved, you would have thought we were in a recession like 2008.
Right.
I mean, truthfully. So that happened last year. Next year, I'm not anticipating the economy to surge to life in any way, shape, or form. Money supply is barely growing, if at all. If at all. The Federal Reserve has made money tight in the economy. Real estate markets have just gotten hammered. They just have a hard time kind of rebounding on that type of thing. And corporate profitability is slowing. So there's nothing out there to suggest, hey, here we go, we're going to grow the economy super rapidly next year outside of maybe a massive surge in fiscal policy, which would be ill-advised because that's the reason why we're having the massive rates of inflation right now.
Yeah.
So, I mean, when I take a look at the economy, I'm thinking, man, we can get to 1.5%. That we should be singing sweet hosannas.
Yeah.
I think the Fed is even predicting 0.5 of a percentage point. So, with that sort of sluggish type growth, it's hard to be jumping up and down about it, but it's still growth, so it's hard to get super upset about it too.
Yeah, and I think it's worth, when people have talked about the GDP prints and whether we're in a recession or not, they've stuck to this sort of rule of thumb of back-to-back quarters of negative GDP.
And there's far more to it than that.
Yeah, that's never been in the definition of it. That's been a rule of thumb from Julia Shishkin in a Times article, a New York Times article, or maybe Wall Street Journal 50 years ago. Yeah. And it seems like this past year that's kind of stuck for maybe not the best motives, people either wanting to say we're in a recession or not due to largely political reasons. But, it's always been depth, diffusion, and duration of how bad this economic slowdown is, how long it's going on, and is it diffused throughout the entire economy. And so that's kind of where the conversation needs to be going about a recession. And we've talked about maybe kind of a rolling recession or what that would look like. Yeah. I mean, if you talk to mortgage lenders right now, it's probably hard for them to not say they're in kind of a recession.
Well, I would imagine the presence underneath the tree for mortgage brokers this year probably going to be pretty thin and sparse. The same with a lot of residential real estate developers. Yep. Even see folks in CRE. It's going to be it's a difficult time. There's no, and when you're talking to these people, they're viewing this with black eyes. I mean, just absolutely saying, my Lord, it can't get much worse than this. However, take a look at some other sectors. It's really not that bad. It's not always going to be that way.
Yeah.
What you're about rolling recession, you're talking about certain sectors getting hammered, and then a different couple sectors getting hammered, and what have you, and just kind of rolling that, just kind of playing leapfrog in terms of the slowdown in that sector.
That's right. And it seems to me like that is the most likely case of kind of where we're at right now. Mm-hmm. Because like you said, and we've seen in the data, some things are still killing it.
Yeah.
I mean, just killing it. Other things like we've talked about, commercial real estate, I talked to someone last week that said they don't know if they're going to have any deals next year.
Yes.
I mean, so you just have this complete separation depending on sector and job or what have you, that some people are having some of the best years and some people are having some of the worst years they've had.
Yeah, so I mean, in terms of next year, though, when I take a look at, again, that crystal ball that I've got in the office, things will get better for real estate because they can't get much worse. That's just kind of low-hanging fruit. It's not going to be what anyone would like. It's not going to be a huge bounce back, but it shouldn't be the death knell that the last 6 months have been for it. Take a look at the economy as a whole. I mean, again, it's just kind of And as a result, my forecast for the markets, for at least for the 6 months, is pretty benign. Really much does depend on just how rapidly inflation does fall. And if we're correct, the Fed will be cutting the overnight lending target by the end of the year, and we could actually see, maybe a high single-digit type return for the stock market. Bonds will probably produce maybe a coupon sort of return, 3 to 4%, and that 60-40 portfolio can get back to a reasonable 5-6% rate of return.
Yeah.
Which is a probable case scenario. Of course, a lot of things can change, and what can change are geopolitical events. I mean, as we end here in 2022, my forecast for geopolitical events is I don't know what in the world's going on in the world right now. I mean, it's crazy stuff.
Well, and the big headline for geopolitical is obviously the Russian invasion of Ukraine, and it's almost worthless to try and make a prediction about what's going to happen.
Apparently, we're giving them Patriot missiles now. So, it's
thinking through this through a logical frame is not necessarily the best way to look at it, because you're using logic. We're using
sort of American logic to try to figure out what Eastern Europeans are going to do.
A logical Eastern.
When Russians look at the United States, they're going, I don't understand what they're doing. So we just don't think the same.
Yeah.
We don't think about Ukraine the same. It's different. So I don't know exactly how long Moscow's going to wait to kind of wait this out, just kind of a war of attrition, bleed Ukraine white. I don't know how much longer Washington's going to have the appetite to continue to shell over billions of dollars in armaments, drawing down our stockpiles in the process, particularly when we have a very increasingly bellicose People's Liberation Army and Navy over in China that is rattling its sabers and, oh, by the way, growing leaps and bounds in both armaments and technology.
Yeah.
So it's will be interesting to see in 2023 what gives. At some point, something's going to give.
Yeah.
Either Ukraine gives or Russia gives, or we give because we just simply can't support the Ukrainians to the degree that we have thus far.
And again, that goes into what makes investing markets so difficult. Is there is, I mean, I joked about it, but there's over 1 in a million events that can happen. These exogenous events.
Yeah.
A global pandemic 2 years ago. I mean, Russia invading Ukraine. I know people have talked about that for some time, but there is millions of things that people have talked about happening at some point that can very easily happen at any day, any moment.
So do you have any predictions what that 1 in a million might be next year? Come on, I'm throwing it right at you, man. Spotlight on Samuel Clement.
Outside of maybe a Dallas team taking home a championship, that's one of
that certainly is a black swan. I mean, let's get serious though. Look,
I don't think the ones I think that are at the top of people's mind, an invasion of Taiwan. Yeah. I don't think that's happening.
I struggle getting there in 2023.
Yeah. I do think inflation. I think we're going to get close to deflation. I really think a lot of we've seen this bullwhip effect on one side of it, shutting down supply, inflation going extremely parabolic.
Yes.
And we are going to see the flip side of that. And, we've talked about the Federal Reserve being wrong a lot, or being late, or being too strong. TOO is a word used a lot for what the Federal Reserve does. Too little, too much, too late. And I think we're kind of going to be experiencing that in the data next year.
There's a song back in the 70s that used that exact line. Too much, too little, too late to ever try in any event. No one wants to
But that's
really
what the Fed does.
But you're absolutely right. It's because, and you and I have talked about this, and it's not necessarily to disparage the Fed, although that's exactly what I'm going to be doing. But when you have people that think in theory, and they're academics by nature, although J-PAL arguably isn't, but most of them are academics by nature that think in theory in terms of spreadsheets and the colored dots on their computer screens, as opposed to actually having to make a budget or, make sure the income statement comes out in your favor and all that stuff. They're going to think a little bit differently than actual business owners are. And so you're also trying to predict the future using calculations, which is, I guess you can try to do it, but that's an imperfect science.
It's a very imperfect science. semblance. I mean, I'm sure you took it. I took econometrics as a class. And
Well, when you have to hold one variable constant in a world that's
Right.
ever changing, then all of a sudden that
the
equation.
whole class is built around holding something constant. And I remember asking me, like, so what do you hold constant? It's like, well, just pick something. It's
Yeah.
like, nothing is constant. There is a caveat with every model you produce saying, I'm making something constant that is not constant.
I fear as though we are digressing.
But, it's just tough to use models, I think, is the point.
I think it's real tough to use models, and I would completely agree with you. If there is one sort of shocking, maybe not black swan, but some sort of outlandish prediction that I'd be willing to bet $10 on with one person, not $10 on with everyone that listens to this, but just say, what is your most outlandish prediction for 2023? It would be by the end of the year we'll be more worried about deflation than we are inflation.
Yeah.
And so
I mean, we said that for
not very long.
Yeah, just right now. This is the first time we're saying that. But I agree completely. I think that's something that I'm expecting more so than continued runaway inflation. We've seen in the data over the past 5 months. If you analyze 5 months of inflation, we're back to 2.5% on the headline number.
Yeah.
I mean, we're kind of there.
Kind of there with recent decreases in global energy prices. Really, the last shoe to fall is going to be that rental equivalency of primary residence, and we're already starting to see anecdotally rates start to, if not go down, certainly moderate pretty significantly after going up like a bottle rocket over the last couple of years.
I mean, if you used current data for rent in this last CPI number, we had a negative number. If you just use the month-over-month change in rental prices, add that into the equation, it's a negative number.
Well, there you go. So we have a couple more months of that. And plus, the way that we calculate inflation, part of the reason why we're saying deflation, we're not necessarily saying that, my gosh, that mayonnaise that is now $7.99 a quart is going down to back to where it was pre-pandemic. What we're saying is the way the calculation is, we'll be taking off some pretty gaudy monthly numbers from 2022. First half of the year, we're seeing 1%, 1.2%, 0.9 percentage point, and we'll be rolling those off and replacing those with 0.
0.1.
0.1.
Maybe a 0.2.
And maybe a 0.2, maybe even a negative number. So we're going to be looking at, by the end of next year, we're going to have 12 months of, 2, 3, 2/10, 3/10 and less. Meaning that that's what we're compounding. We're going to see a much different inflation number, and it's not going to be anything that that really Washington did. It's going to be the nature of the beast and the fact that the money supply has cooled pretty significantly. We start seeing elements of the economy, thanks to the Federal Reserve, go absolutely into recession, and it's impossible to think we're going to see inflation anywhere close to what we had this year. Ergo, our black swan or outlandish prediction for 2023, drumroll, Sam and I both in agreement, be more worried about deflation.
That's right.
There you go. So that's what we're looking for.
I don't expect any.
I'm not expecting deflation, money supply decreasing by 1/3, Great Depression type stuff.
No. It's looking at the calculations, and probably some prices really actually coming down, but. Yeah. Again, you got to look at it in a relation to where it was 12 months ago, 2 years ago, 5 years ago. I don't think we're getting back to 5, 10 years ago prices on things, but I think we're going to see some prices come down. And, outside of that, those headline, predictions or fears that people have, like we said, Taiwan, North Korea, I don't see that.
We can't control that.
And it'd be like, predicting COVID in, December of 2019. No one's...
Well, we're predicting that Vladimir Putin was going to invade Ukraine in the summer of 2021.
Yeah.
Maybe.
Yeah.
But I wouldn't have bet any money on it.
Sure.
So that type of deal. So you're right. So there we go. Well, guys, we always love to hear from you. Also, we'd love for you to drop us a line at tradingperspectives@oakworthcapital.com. Or you can leave us a review on the podcast outlet of your choice. I am butchering this, and I apologize. As always, if you're interested in reading more or hearing more of what we have to say, what we think, you can always go to oakworthcapital.com and take a look underneath the Thought Leadership tab. It's actually oakworth.com, and take a look underneath the Thought Leadership tab for all kinds of exciting information. Sam, after I completely butchered that, I'm going to throw it to you to try to save us here today.
All I've got.
That's all I've got today, too. Y'all take care.